Well, crop insurance will be important for many farmers this year, particularly in the western growing regions. However, there's recently been confusion over the rules for deferrability payments. Now, Roger McEowen with the Washburn School of Law joins us now with some clarification. Roger, good to have you with us. Now, how does someone go about determining whether the receipt of crop insurance is deferrable for income tax purposes?
Morning, Tammy. Good to be with you. And you're right, this is an important issue, particularly in the areas in the western part of the Corn Belt where drought was a real problem. But the starting point with respect to crop insurance is, of course, make sure you're on the cash method of accounting. You have to be on the cash method of accounting, and you must have a practice of deferring a substantial portion of your crop into the next year. And you have to establish that to the satisfaction of the IRS. And so those are your two main requirements. And then it has to be crop insurance, disaster payments, or prevented planting payments that you received this year for crop loss that you can defer into next year. If you get them next year for a crop that you grew this year, that's already deferred and you can't defer those again.
Now, what if there are multiple crops involved?
Well, if there are multiple crops, you have to meet that substantial portion test or substantial amount that you have a practice of carrying over into the next year. If you have multiple crops, one way to deal with that is to have an entity for each crop. And then, of course, you're going to meet the substantial portion test with respect to each of those crops. If you don't have that, then the test is done in the aggregate. And so you have to show that your practice of deferring has been more than 50%, and that's what you're doing in the aggregate. And then you're going to be able to defer the crop insurance proceeds.
Now, what if the deferral provision also applies to new types of crop insurance?
Yeah, and that's where it gets tricky. We have crop insurance that's paid because of revenue loss or yield loss, and that part of a payment is not deferrable because the tax code only allows deferrability with respect to crop insurance received on account of physical damage or destruction to the taxpayer's crops. And so if it's revenue-based or yield-based, you're going to have somebody pull that policy apart for you, pull those proceeds apart, and get you a determination of what is actually tied to physical loss to the crop, because the portion that's tied to revenue or yield is not deferrable. And that's the tricky part.
Now, this continues to create confusion for farmers. So what is the big takeaway that they need to remember moving forward?
Well, your basic principles, I have to be on the cash method of accounting. I have to have a practice of deferring a substantial portion of my crop, watch that 50% test, and then have your insurance company break it down in terms of the part of the payment that's attributable to yield or revenue and the part that's attributable to physical damage to the crop. Because, again, only that physical damage portion is going to be deferrable.
All right, that clears a lot of things up for us. We sure do appreciate it. That's Roger McEowen with the Washburn School of Law. Thanks for your time today.